And I'm going to start with the introduction. Okay, introduction. Finance play a very important role in every organization because it involves in the management of money, asset, and financial resources. Good financial management help a company operate efficiently, remain financially stable, and achieve long-term goals. To understand a company financial condition, we need to rely on financial position, profit or loss statement, and cash and flow statement. This statement will provide a valuable insight into a company performance and financial health. And the purpose of this study is to analyze and compare two financial companies in Malaysia in order to evaluate the financial stability and the operational effectiveness. Right now, we're going to continue with company background. The first company in the study is Rich Energy Berhad. Rich Energy Berhad is a Malaysian oil and gas company listed in main market of Bursa Malaysia. Its core business activities include the exploitation, development, and production of crude oil, with its main operation located in Kazakhstan. The second company is Hiap Holding Berhad, which operate in very different industry. Hiap is listed in East market of Bursa Malaysia and involved in environmental service such as waste management, recycling, and refining. The company places a strong emphasis on sustainability environment compliance in its operation and the methodology in this research. In this study, we use comparative financial performance analysis approach. The data analyzed are secondary data obtained from the annual report of both companies from the latest financial year. Several key ratios are used to evaluate the performance, including liquidity, profitability, efficiency, solvency, and market ratios. These ratios allow for a fair comparison between the two companies. And finally, the results are interpreted by considering differences in the industry characteristics and business strategies, providing meaningful insight for investors and for other stakeholders.
Despite of this presentation, I will be discussing the liquidity ratio, focusing on the current ratio for two companies, Hiap Berhad and Rich Energy Berhad, across the years 2023 and 2024. The current ratio is a measure of a company's ability to pay off its short-term liabilities using its current assets. A ratio above 1 generally indicates that the company has sufficient assets to cover its short-term debts. Looking at the results, Hiap Berhad recorded a very strong current ratio of 4.88 in 2023. However, in 2024, this figure declined to 2.01. Although the drop is significant, a ratio of 2.01 still represents healthy liquidity, meaning the company can comfortably meet in short-term obligations. In contrast, Rich Energy Berhad showed a very weak current ratio of only 0.21 in 2023, which increased slightly to 0.22 in 2024. This marginal improvement is not enough to change the overall picture, as the ratio remains critically low and signals high short-term financial risk. If we look at the chart, the difference between the two companies becomes even clearer. Here, Huat's bars are much higher, especially in 2023, though they fall in 2024. Rich Energy's bars remain very low, with almost no improvement. The visual highlights a sharp contrast. Here, Huat still maintains strong liquidity, while Rich Energy Berhad continues to face serious short-term risk. The implication here is that Hiap Berhad remains in a safe liquidity position, but the downward trend should be monitored closely. On the other hand, Rich Energy Berhad's ratio below 1 is a red flag, suggesting that the company may struggle to meet short-term obligations without external financing or restructuring. For this slide, I will be explaining the quick ratio analysis for Hiap Berhad and Rich Energy Berhad for the years 2023 and 2024. First, let me briefly explain what quick ratio is. The quick ratio measures a company's ability to meet its short-term obligations using its most liquid assets such as cash, receivables, and bank balance. Starting with Hiap Berhad in 2023, the company recorded a very strong quick ratio of 3.23. However, in 2024, the quick ratio declined to 1.42. This suggests that Hiap Berhad remains financially stable and capable of meeting its short-term obligations, but with reduced liquidity flexibility compared to the previous year. In contrast, Rich Energy Berhad shows a much weaker liquidity position. In 2023, the company recorded a very low quick ratio of 0.1, indicating that its liquid assets were insufficient to cover short-term liabilities. In 2024, there was a slight improvement to 0.22. If we look at the bar chart on the right, the difference between the two companies is very clear. Hiap Holdings shows significantly higher bars in both years, although there is a noticeable decline from 2023 to 2024. Meanwhile, Rich Energy Berhad's bars are consistently very low for both years, reflecting its weak liquidity position with only marginal improvement.
Hello and hi, my name is Muhammad Ikwan bin Nizam. I want to continue this presentation in profitability ratio. First, in terms of gross profit margin, Rich Energy performed significantly better than Hiap in the both year. Rich Energy recorded high margin of over 80%, indicating strong control over direct production costs. In contrast, Hiap gross profit margin declined sharply from 26.39% in 2023 to 13.91% in 2024, suggesting increased cost pressure and reduced pricing power. Next, looking at the net profit margin, Hiap outperformed Rich Energy. Hiap remained profitable in both years, although its margin decreased from 9.10% to 2.74%. On the other hand, Rich Energy experienced significant losses in 2023 with a very large negative margin. Although the losses were reduced in 2024, the company still recorded a negative net profit margin. Moving on to return on asset, Hiap again showed better performance, recording positive ROA in both years, which indicate efficient use of asset to generate profit. Rich Energy, however, report negative ROA in both years, showing poor asset utilization despite some improvement in 2024. Finally, in terms of return on equity, Hiap provided positive return to shareholders in both years, although the return declined. In contrast, Rich Energy ROE was extremely negative, indicating substantial losses to shareholders. In conclusion, although Rich Energy shows strong gross margin, Hiap demonstrate better overall profitability and financial sustainability. Thank you.
First, let me briefly explain what inventory turnover ratio measures. The inventory turnover ratio shows how many times a company sells and replaces its inventory within a financial year. Starting with Hiap Holdings Berhad in 2023, the company recorded an inventory turnover of 6.45 times. That indicates a relatively good level of efficiency in managing and selling its inventory. In 2024, the inventory turnover increased significantly to 9.04 times. In contrast, Rich Energy Berhad recorded an inventory turnover of 6.27 times in 2023, which reflects moderate efficiency in inventory management. However, in 2024, the ratio declined slightly to 6 times. If we look at the bar chart on the right, the trend becomes very clear. Hiap Holdings shows a noticeable increase in inventory turnover from 2023 to 2024, represented by a much higher bar in 2024. Meanwhile, Rich Energy Berhad shows a slight decline, with the 2024 bar being marginally lower than in 2023. This visual comparison highlights the widening efficiency gap between the two companies. On the other hand, Rich Energy Berhad shows weakening efficiency, with slower inventory management in 2024, which may indicate sales challenges or less effective inventory management. Now, let's move on to the fixed asset turnover analysis, which measures how efficiently a company uses its fixed asset to generate revenue. As shown in the chart, we are comparing two companies, Hiap Holdings Berhad and Rich Energy Berhad, across the years 2023 and 2024. Starting with Hiap Holdings Berhad, the Fed ratio was 2.29 times in 2023 and it was increased slightly to 2.38 times in 2024. This upward trend indicates that Hiap was able to improve its asset utilization, generating more sales per ringgit of fixed assets. This reflects strong operational efficiency and effective use of resources. In contrast, Rich Energy Berhad recorded a Fed ratio of only 0.25 in 2023, with a marginal increase to 0.26 times in 2024. Despite the slight improvement, the ratio remains very low, suggesting that Rich Energy is struggling to convert its fixed asset into revenue. This points to poor asset utilization and potential inefficiencies in operations. Visually, the bar chart reinforces this contrast. Hiap's bars are significantly taller, showing consistent and strong performance, while Rich Energy's bars remain short, highlighting its weak efficiency.
The leverage ratio that stands for 3 ratio is debt ratio, debt to equity ratio, and time interest earned that cover two companies, HH Corp and Rich Energy, for 2 years, 2023 and 2024. For HH Corp, the debt ratio and the debt equity ratio is showed very low. That means company use very little debt. For time interest earned, that showed a drop from 9.45 times in 2023 to 3.7 times in 2024. That showing a weaker ability to cover interest expenses compared to the last year. For the rich energy Berhad, the debt ratio and debt to equity are much higher. They indicate company highly leveraged and depend more on debt. For time interest earned, that made some improvement from 0.45 times to 6.59 times. That show the higher debt level, but still show greater financial risk. In conclusion, HHCO is more financially stable while rich energy carries higher risk due to heavier debt usage. The market ratio that cover two ratio, APS dan PE ratio, for HHCO and rich energy Berhad, they also cover 2 year 2023 and 2024. For HHCO, APS decreased from RM1.94 to RM1.02 in 2024, meaning that company earn less profit per share. For PE ratio, they also increased. That suggests investor may still have confidence in its future performance. For rich energy, APS increased slightly from 78 cents to 85 cents. That showing a small improvement in profitability. For PE ratio, they also increased. That's indicate made some improvement for investor expectation, even though the value are still relatively low. In conclusion, HH Corp show stronger earning overall, while rich energy show gradual improvement but remain less interactive to investor compared to HH Corp.
Hello everyone, my name is Muhammad Ramin. So today I will present about my part, which is I will compare Rich Energy Berhad and Hiap Huat Holding Berhad using key financial ratio. For the first, liquidity. Hiap Huat shows strong liquidity, meaning it can easily meet short-term obligations. In contrast, Rich Energy is weak in liquidity, struggling to cover its short-term liabilities. For the next is profitability. Hiap Huat consistently generates positive profits, while Rich Energy reports negative profitability, showing it is not converting revenues into earning effectively. For efficiency, Hiap Huat demonstrates better use of asset and inventory, reflecting strong operational performance. Rich Energy, however, is inefficient in managing its resources. Regarding leverage, Hiap Huat carries low financial risk with manageable debt levels, whereas Rich Energy faces highest risk due to greater financial stress. For the last is market performance. Hiap Huat has a strong investor confidence as shown by a positive earning per share and a better market perceptions. Rich Energy shows weak market performance, indicating low investor confidence. In summary, across liquidity, profitability, efficiency, leverage, and market performance, Hiap Huat outperforms Rich Energy, showing stronger financial health and stability. Thank you.
Hi, my name is Shen. Now I will present the conclusion of our financial analysis. This report compares the financial performance of Rich Energy Berhad and Hiap Holding Berhad for the years 2023 and 2024, focusing on liquidity, profitability, efficiency, leverage, and market ratios. From the overall findings, Hiap Holding Berhad clearly demonstrates stronger financial health and stability. The company maintains healthy liquidity ratios, remains considerably profitable, and uses its assets more effectively. Its lower leverage and stronger market indicators also reflect higher inventory confidence. In contrast, Rich Energy Berhad faces significant financial weaknesses. Its liquidity remains below the safe threshold, profitability continues to be negative, and its asset utilization is inefficient. The company also carries higher leverage risk, especially in 2024, which affects its ability to convert interest obligations. Overall, the comparison shows that Hiap Holding Berhad is financially stronger and more stable, while Rich Energy Berhad must address key financial challenges to improve future performance. I continue to present our recommendation for both companies. For Hiap Holding Berhad, the key focus is sustaining profitability. Firstly, the company should strengthen cost control by addressing rising operational costs to prevent further decline in profitability ratios. Secondly, Hiap should maintain conservative leverage while pursuing growth. This means continuing expansion through well-planned investments while keeping debt levels low to ensure financial stability and maintain investor confidence. For Rich Energy Berhad, the priority is improving liquidity and cash flow management. The company should strengthen receivable collection, control short-term expenses, and consistently returning its short-term debt. In addition, Rich Energy needs to enhance asset utilization and cost efficiency by improving fixed asset user and reducing operating and financing costs. These actions are essential to help the company move for gross profit toward achieving a positive net profit. Overall, this recommendation aims to improve financial performance and long-term sustainability for both companies. That's all for our presentation about comparative financial performance analysis of Rich Energy Berhad and Hiap Holding Berhad. Thank you.